corner for you. Thanks a lot, Vinny. See you again 24 hours from now. We're now going to move over the primary markets. There's been so much action recently, right? You had a muted listing of BKG, a 20% pop as far as the Medanta IPO goes, and today we have seen another strong listing. This is to do with Kaynes Technology and an IPO pop of nearly 30% at the time when it listed. A strong market debut, listing price of 778 rupees as compared to the IPO price of 580 rupees, coming off since then. But as you can see, higher by $100 a share, higher by 17.5%. So very, very strong listing. And let's now touch base with the top management joining us on the channel, the Managing Director, as well as the CFO. Thank you so much for joining us here. I'll pose my question to Mr. Kunikanan, the Managing Director. Thank you so much. First up, congratulations to both of you. A 30% pop is what we have seen from Kaynes Technology. Let's see the momentum can continue. But a lot of our viewers, a lot of your new retail investors will also want to know about the road ahead, what they can look forward to at Kaynes. Listing is done, how to build on the momentum, and that's what we'll focus on during this interview. What I would like to first ask you is, and let's get this out of the way, a part of your proceeds in the IPO will be used for debt repayment. What is the timeline? 530 crores, a lot of that is going to be used for debt repayment. By when is that likely? Will you be a zero debt company?
We will have a net debt of around 40 crores after the repayment, and we also will be saving around 1.8 crores a month.
Okay. Oh, so you'll be able to save as well, and that'll bring me to the next part of the question. And gentlemen, whichever one of you want to actually take this, we have seen negative cash flows, and you've talked about the negative cash flows from operating activities in the June quarter. That has been attributed to, rising overheads, fixed costs, as well as working capital. What has been the material impact of this on your operations, and what will be the impact going forward?
This is the first quarter of the year, and typically first quarter of the year, the business expected about 16%, though the costs remain almost similar to any other quarter. And also this is the quarter where we kind of get more and more materials to provide for the growth. So I think it is to be expected that in the first quarter, it's like an investment cycle. We get more and more materials so that we can, as you know, we have an order book of 2,200 crores. And so that needs to be, quickly delivered. So it is good that we have increase in working capital cycle with inventories coming in so that we can fulfill the orders.
And in our business, the cycle is always like this. First quarter will be always less, last quarter will be high.
All right. Now, Ramesh, there is also increasing competition in the electronic system and designing manufacturing industry that could create some pressure on pricing and market and even affect your business. Are you well positioned to tackle the competition?
In my opinion, there is enough markets available. Today, we can convert all imports of PCB assemblies which is coming from outside. That itself is a market for 10 players like us. So I am not expecting any big impact because of competition. Price pressure is a continuous activity, but that will not affect any performance.
So do you intend to pursue inorganic growth opportunities then via selective strategic acquisitions with the foray into the consumer electric segment? Will you pursue these strategic investments, other alliance partnerships, etc.?
This will definitely happen because in my opinion, there will be consolidation happening. So as a part of that, there will be alliances happening, there will be strategic investments happening. So we are also prepared for it, but we wanted to go step by step.
Okay, and I'd like to take this question, pose this question to the CFO, and this is as follows. And I'm looking at the numbers here. There were low margins in FY20 as well as FY21. We've seen those margins improve quite significantly in FY22, and that trend continued into the first quarter of FY23. Should your shareholders get used to this, the margin expansion?
So fundamentally, there were three reasons for the increase in profitability in the FY22. One was that during FY21 we did incur significant costs on account of COVID, etc., in terms of freight, etc., because of COVID protocols. The other reason is that there have been significant growth, about 67% in FY22. So that has given us a better absorption of overheads. And also our margins are driven also by the nature of industry and the proportion of each industry. So we had a reasonably stable profile of different verticals in our business. And going forward, based on the order book, we can say that it is similar to what we have had so far in FY22. And since the order book is also kind of 2,200 crores to be delivered over 1.5 years' time, so in terms of its velocity of delivery also is growing at 60-odd%. So we think that similar factors would apply, and conditions will be similar.
I'd like to pose this question to you again. If you look at it, the top 10 customers account for over 60% of the company's revenue. So if you lose one of these customers, will there be an adverse impact? The question I'm trying to ask is the company too overexposed to these 10 customers?
Yeah, see, while top 10 do account for 60%, so going forward, now we are actually, if you see FY22 and up to about June, we've had more larger customers acquisition. So we think that it is more like equally powerful horses pulling. And there are upsides available in our business plan. As you know, the open order status is one such indicator. So we think that it may not significantly affect our business prospects in the short run. But of course, we do always carefully monitor the performance and the offtake from each customer. And we do course corrections. We have a system of review. And we make sure that, that is not allowed to affect our overall performance because we are actually present in all the 6 different sectors. So we are a diversified portfolio company.
And finally, Ramesh, what is the outlook going forward for the company?
See, since we are a diversified company, we wanted to have the percentage maintained between verticals. So we have restructured our company, having heads handling each vertical. So I am very certain that the growth plan, what we have projected, should happen without any difficulty. Up to 24, we have orders fully covered. So thereafter, we have started working in. Going forward, our long-term plan is to grow at a very steep level.
Gentlemen, appreciate your time. Thanks much for taking time out and joining in. That's the latest from Kaynes Technology, talking about how after the repayment of the net debt is going to stand at about 40 crore rupees, they're going to be saving close to 1.8 crores per month, and price pressure will not affect performance.